Hello, this is Tim Mueller, Business Intelligence Master's Student with Full Sail University. This is a presentation titled To Buy or Not to Buy, Analysis of Union Pacific Stock Performance. So by Union Pacific, I am talking about the Union Pacific Railroad. And everybody recognizes these iconic yellow and gray locomotives. And this quote below by Greg McFarland is from an article on Investopedia.com, and it just sums up the railroad industry quite well. The heyday of most industrial revolution innovations came and went a long time ago, but if you need to ship titanic volumes of sundry products across sweeping distances, nothing anyone's invented in the last 150 years can beat rail. So let's look at a brief history of the company. It is quite unique. They're headquartered in Omaha, Nebraska. They were founded by Abraham Lincoln in 1862. Union Pacific Railroad Company is principal operating company of Union Pacific Corporation. They operate in 23 states west of the Mississippi and have over 32,000 miles of track with over 8,500 operational locomotives. The railroad business. So their business is pretty much B2B. They have multiple different factors that drive their business. The chart to the right is from their 10K report and shows the percentage each of these industries contributes to the overall business of the Union Pacific. They are the largest railroad in the United States, and they just recently acquired Southern Pacific, making them actually the largest freight line in the entire world. They are a $110 billion corporation, so they're quite large. The data for this analysis is stock information gathered over the past 5 years. We also gathered a quarterly PE ratio, and if you ever want to look yourself, you can look at their symbol of UNP. So a couple different indicators to look at in terms of stock performance. PE ratio is the most common indicator for stocks. It's the price per share divided by the earnings per share. So this little table is going to show you four railroading companies, and just looking at their PE ratio. So Union Pacific has a PE ratio of 28.42 and CSX is 27.5. So in this chart, CSX looks like the winner, but the important thing with stock indicators is that you have to look at multiple indicators to get a full picture, but PE ratio is the most common. Another common one is earnings per share, or also known as EPS. It's insight into the company's earnings health. And this is a simple formula of net income divided by outstanding shares. So while CSX had a very high PE ratio, they actually have a very low earnings per share ratio of $1.83. Union Pacific is quite high at $5.23. Another great ratio to look at that is a little bit more broad than PE or EPS is PEG. So the PEG ratio is the PE ratio divided by anticipated growth in earnings. It's a better indicator for valuation because it's looking into the future, and the closer the number is to 1, the better the valuation is of the stock. So Union Pacific, CSX, and Norfolk Southern are all pretty close to 1, so that's a pretty good indication that they're going to see positive growth and that the stock is priced right. But Canadian National is at a 4.07. That stock is overvalued. Most investors would not go with Canadian National at this point. Another type of analysis that can be performed is correlation analysis. So there's two that I did for Union Pacific. The first would be covariance, and using the data analysis tool in Excel, this looks at the PE ratio and the adjusted closing price to see if there's a positive relationship between the two. The table to the right, the number to look at is the 81.58. This is a nice positive high number that shows that there is a very positive relationship between the PE ratio and the adjusted closing price, which kind of can help give an idea of valuation and if the price is accurate for the stock. And then a correlative relationship can be done as well using the same data analysis tool in Excel. So the number to look at here is the 0.775 or 0.78. The higher the number is, or the closer to 1, the better off we are. So again, there's a nice strong correlation coefficient between the PE ratio and the adjusted close. This isn't with everything within a stock. I did a correlative relationship between the volume and the PE ratio, and they were so far off there's no relationship between the two. So it's not every indicator in the stock that is in terms of price and volume moved each day will have a positive relationship. So this is just another way that someone who's interested in purchasing stock or maybe selling stock can evaluate to see if it's valued correctly. Whale watching. So another way to look at how stocks are performing is to look for the big investment houses purchasing large volumes of stock that affect the overall stock price. So there are a couple instances where we can see whale tracks, and the chart here created in Tableau is going to show you the average adjusted closing price, the blue line, and then the bar charts, the volume moved per month in that year. So there are three instances of whale tracks that appear. The first would be in 2012, where you see a large spike in volume and then the price somewhat evens out. Then again, it happens right before 2014. And then again, right in 2016, after the price had been down for a while in 2015, there was a large buy in stock that started to creep the price back up. Support and resistance. So where is their support and where is their resistance? This chart is looking at the average price for the average adjusted closing price. And there are two support and resistance lines because this stock was really up and down, had dramatic growth, dramatic decay, and then growth again. It was hard to place a bunch of support and resistance lines in here. So there are two that have the most touch points of peaks and valleys. So the 75.00, the red dotted line at the bottom, is going to show where there's the most support, where the stock will most likely rebound in a positive direction once it hits that line. And then at the top at the 110, it's the opposite. That's the line where most times when the stock hits that, it's going to come back down. Also with this, there's a forecasting tool inside of Tableau, and when that was run on these numbers, it came up with a little bit of a forecast, which you can see in the light blue at the end. It is showing positive growth for the stock back up to the 120 mark per share, which is what was one of their highest prices ever. But the cone of uncertainty there is pretty wide, so there's still the chance for a stock to go down. Just an interesting forecast to look at. Bollinger Bands. So again, this was built in Tableau to display the bands for the UMP stock. And this is showing us the two gray lines are the standard deviations from the mean, which is the red line, and the blue line is the actual average price. And pretty much Bollinger Bands are a way to say more often than not your price is going to stay within two standard deviations of the mean, and this chart is displaying that. And you can see there's a couple times where the actual price will break one of the bands that's displayed in yellow. It's not very often, and it's not very it doesn't really shoot above the upper band or the lower band. It just kind of crests over and then comes back down. So with Tableau, the chart actually gives the ability to adjust the standard deviation, so you can do further analysis to see just what would it look like if it was at, so this is 2, and then here is going to be 3 standard deviations and 4 standard deviations. And what's interesting with this is the closer this actual price is to one of the lower band or one of the bands, either lower or higher, is an indicator of either buy or sell. So if it's close to the lower band, you buy. If it's close to the upper band, you sell. And what does that tell us? It tells us that 2015 was the year to buy. And that in that year, the PE ratio had dropped from over 20 to 13.41. But 2016 going into 17 was the time to sell. And using the Bollinger Bands, if we have kind of a magnified view here of that chart of the right-hand side, my recommendation would be to hold all shares at this point. The bands are coming in close together. You can see the two gray bands both sharply come in close to the average and the stock price. And the stock price is starting to get to where it was maxed out before at 120, right before it started coming back down. So there's some uncertainty here. Is it going to continue up or is it going to drop back down? So I recommend hold. This chart here is just comparing volume being moved in the red compared to the price difference average per quarter. So looking at each quarter for the past 5 years, it's comparing the average price difference for the adjusted close per day. So you can see that from 2012 to 2014, there was all positive growth. And then 2015, it was all negative decay in the price. And then 2016, everything started to rebound. But right there in the end of quarter one 2016 and quarter four 2015, you can start seeing the volume of stock started to move and swing that price back up. So the prediction and my recommendation again is still to hold. There is slightward upward movement. The trend line from displayed here in yellow, it is showing slight upward growth. It's not as drastic as the forecast was in the previous slide, but it's not very certain which direction the stock is going to go. Again, we're getting up close to where it was at its peak in 2015 at $120 a share. So we don't know if it's going to hit that again or drop back down. If it goes up and it hits that high again, sell, sell, sell. If it starts coming back down, buy up more shares. So another thing too is also wait for the whales to show up and watch the volume being traded each day. If we start to see more whale tracks, that's going to be an indication of it's time to start watching the game a little bit more serious and seeing if we're going to buy or sell. And this last slide is just references used for this presentation. Thank you for your time.